Joining me is Chief Investment Officer at the Motley, Scott Phillips. Good morning to you, Scott. Australia's largest banks are making significant cuts in the interest rates they pay on term deposits ahead of the Reserve Bank. Why is this significant, do you think, and what is it telling you?
Kenny, good morning. Yeah, they are, and not good news for depositors. If you wanted a higher rate term deposit, it's been a long time between drinks. Last few years, depositors have got a decent amount of money. Before that, it was a while since rates have been this high. Of course, that's true also for mortgages. When you put those two together, what the banks are effectively betting on is that rates will be lower rather than higher in future. Now, if you take a 5-year term deposit, for example, if I'm going to pay as a bank a depositor for 5 years, I got to know I can offset that with a loan of the same duration. They call it duration matching. That's what the banks do to make sure they've got their assets and their liabilities lined up. What it's really telling us, mate, is the funding they are getting, i.e. deposits, they expect to only be able to lend that out at lower rates. In other words, they expect mortgage rates to come down. So does everybody else, I think. There is some conjecture about when that might start happening. The bond market, expecting in November. The RBA saying not until next year. Some of our big banks are also already calling it for happening in November. So what they're really doing, mate, is they're showing their hand. They're saying we expect rates to be lower. We are going to have to lend out at lower rates. Therefore, we have to pay depositors less money, particularly those long-term term deposits.
It's interesting, though, because the housing market here in Australia seems to be softening too. Rental price growth has stagnated as well. Could we see a fall in house prices in the next year, or is this just more supply coming onto the market heading into the spring season?
Mate, it's going to be fascinating. Look, if you think about the cost of money, in theory, as the cost of money goes down, asset prices should go up. That's the way the investment maths is supposed to work. And it makes sense, right? If the bank manager tells you can afford to pay back X dollars a week or a month on your mortgage, when the rate is lower, that repayment will buy you a more expensive house. And so it should put upward pressure on house prices. Now, it doesn't mean it will necessarily happen. There's a lot of other things going on as well. Changes to population growth through immigration, inflation, of course, more broadly, taking bites out of people's paychecks. So hard to know for sure, but I would suggest as and when rates fall, it should put upward pressure on prices. Whether it's enough to push them meaningfully higher or simply stop them falling, that might be an open question. But the trend or the pressure is definitely going to be up as rates come down.
Just finally, Scott, everyone is expecting the Federal Reserve to cut rates next month. In fact, Tom Petrovsky is telling us that the Federal Reserve is going to enter quite an aggressive rate-cutting cycle. Are you expecting still a soft landing for the United States? And how could that aggressive cycle affect us here?
Yeah, I mean, predictions are hard, Kenny. I've got to say, I'm the guy who says I don't make predictions, and I hope that my interlocutors are okay to let me get away with it. No one knows what's going to happen next, but we know the Fed has said they want to cut rates in September, so we can reasonably assume that's a lock. Now, if they're going to cut rates, they're doing it because they expect economic weakness in the US domestically, of course. That impacts us globally. Can they avoid a hard landing? Yeah, they can. But this is a really, really difficult one, mate. We're landing, on aircraft carriers when it comes to this sort of thing. And so it's really, really difficult at the best of times. So many moving parts. No one knows what's going to happen when we get there. So the Fed's looking forward and saying, gee, in 6 months' time, when this rate cut has its impact, what will the economic circumstances likely be? How much support, how much stimulus, how much contraction do we need to put into the economy to make sure we have a softer landing as possible? It is the most likely outcome, but it's not guaranteed. Here at home, mate, a big challenge. If the US does go into recession, the US is the world's largest economy, but more important for us, it's the world's largest consumer economy. And so the old line, when the US sneezes, Australia catches a cold, remains every bit as true as it's ever been. If they did have a recession, I think it'd be remarkably difficult for most of the rest of the world to avoid one, quite honestly, given how weak our GDP growth is right now. If they had one anytime soon, you could almost lock in, I think, an Australian recession, even if it's only a small one. We're growing at 0.2%, right? There's not enough fat in that number to sustain any meaningful reduction in global growth, particularly in Australian exports.
Scott Phillips, we've got to run. I appreciate you coming on the program.